So guys, we are going to start with not chapter 10, chapter 11. Chapter 11, here it is. Today we are discussing differential analysis and ultimately, how do we go about pricing our products? So, chapter 11, this is managerial accounting, Sun Gauge, and here we go. Welcome, guys. Hey, how was the second midterm exam with chapters 6 through 10? How did you guys do? Anyone?
They do very well.
No. Were you able to get some of the questions from the study guide?
Yes.
Good. Okay. Okay, so we're going to talk about how we price our products. So differential analysis. We're going to just go over kind of some definitions here. It can be called incremental analysis. And we basically look at different differential revenues and costs in order to determine the impact on profit of two different alternatives. The differential revenues going to be the amount of either the increase or decrease in revenue that's going to happen from the course of action we're going to take compared to what the alternative may have been. The differential cost is the amount of increase or decrease in cost that's expected from the course of action compared to an alternative. And then the differential profit or loss is the difference between the differential revenue and the differential costs. Differential profit looks at a decision that's supposed to increase income, where the differential loss looks at how that decision is going to decrease our income. So that's just giving you an understanding of some of the wording we're going to be using today. We're going to take Bryant Restaurants, and here we're looking and we're going to see that Bryant is looking at maybe taking away some tables and putting in a salad bar in lieu of the space for those tables. So the first alternative is to keep the tables. The second alternative is to remove some of those tables in lieu of a salad bar. And then what the effects are is basically what we're seeing, the difference in revenue and the difference in cost, ultimately the differential net income as a result of choosing the alternative 2 over the alternative 1. So the differential revenue in picking a salad bar over tables is 20,000. The differential cost of having that alternative to that salad bar instead of the tables is $5,000. Our costs are going to increase 5,000, but our revenues are ultimately going to go up 20,000. And then as a result of our revenues going up 20 and our costs going up 5, our differential profit on choosing the salad bar over the tables would be 15,000. You see here, revenue from alternative 2 is 120. Revenue from alternative 1 is 100. So the increase would be 20. The increase in cost would be 5, which makes our profit 15,000. So what, based on all kind of speculation, based on this differential analysis, Bryant should replace some of the tables with the salad bar because it believes as a result the profits are going to go up 15,000. Now, another method in looking at differential analysis um, looks at, should we lease equipment or should we sell equipment that's no longer needed? So this Marcus company is looking at possibly leasing a piece of equipment or selling it. It tells us here the equipment cost 200,000. We've already taken in depreciation on it 120,000. So the book value of this equipment is 80,000. If we lease it, which would be alternative 1, it looks like we would have 160,000 in revenue for 5 years, but with that revenue will come costs, which look like the repairs, insurance costs would be about 35,000. Or if we choose to, instead of lease it, sell it, it looks like we could sell it for 100,000, but we would be paying an expense of 6% on that 100,000. So here is what the prospective options are. So in this case, with what they know, the alternative 1 for leasing the equipment would be a profit of 125. To sell the equipment would be a profit of 94,000. So if we went with alternative 2 over alternative 1, that would be a loss of 31,000 in choosing alternative 2 over alternative 1. If the equipment is sold, then in that case, our differential revenues are going to go down by 60. Our differential cost will decrease by the 29,000, but we'll ultimately have a decrease in profit of 31,000. So if we're doing it just based on numbers, we should lease the equipment. In this differential equation, we are only looking at the differential revenues and costs associated with the decision. Sunk costs, we can't do anything about. And we've always heard that. Sunk costs have already happened. They're in the past. And nothing with sunk costs helps make our decisions for the future. They're not included. So for Marcus, the book value of the equipment, meaning the depreciation we've already taken, is a sunk cost. It's already happened. And therefore, because of that, that is not going to influence our decision. So another way we look at differential analysis is by thinking, should we discontinue a product line that might not be doing well? If we discontinue a product line or maybe a certain portion of the business operations, then it will eliminate the variable costs. It would eliminate our direct materials, our direct labor, our variable factory overhead, and our sales commissions. But the fixed costs are going to not be eliminated. They'll still be there. So even though we might eliminate um, a segment, it's possible for total company income to decrease rather than increase if the unprofitable segment or product's going to be discontinued, just because of those fixed costs. So we're going to look at Battle Creek cereal, and we're going to look at a particular product, the bran flakes, and look at how we would uh, view differential analysis based on the bran flakes being discontinued. So with Battle Creek, we've got corn flakes, we've got toasted oats, and we have bran flakes. So the corn flakes and the toasted oats are profitable, but the bran flakes are losing money. You see, there's a loss here of 11,000. So in overall, the companies got profits of 69,000 with the loss of the bran flakes. What would happen if we eliminate? Sorry, it's telling me my internet's unstable because I'm on wireless right now. Sorry about that. So with the bran flakes, we have an overall profit in the company of 69,000. In Exhibit 4, if we discontinue the bran flakes, it will decrease our profits and operating income by 15,000, even though with the bran flakes, those bran flakes are causing an 11,000 loss. So as you see here, by discontinuing bran flakes, we would have a loss of 26,000. But if we continue with the bran flakes, we do have a loss of 11,000. But ultimately, if we discontinue it, just because of our fixed cost, we're going to end up incurring a larger loss overall. Another way of looking at differential analysis is when we consider making something or buying something, purchasing something. Companies manufacture products made up of components that are put into final products. So oftentimes, manufacturers have to look at whether to make a part or to purchase it outside the company. Let's look at an automobile manufacturer, and they've been purchasing from a supplier the instrument panels for a $240 a unit. Now, the factory that the auto manufacturer is currently producing is only operating at 80% of capacity. So basically, they have available capacity to potentially make these products in-house. But look at this, the cost per unit of manufacturing the instrument panel is going to be $280. They're buying it outside at $240. We can make it internally for $280. So if we make the panels, the cost is $280. If we buy the panels, the cost is $308 because of the fixed factory overhead that is fixed and isn't going to change. So as you see here, it's showing that it may behoove us to make the panels, to choose alternative one over buying the panels from a supplier. If the make price is $280, and if we just compare what we're making it for versus what we're buying it for, then we would buy them. But if we take into account the unused capacity we have in our factory, because we're only operating at 80%, then if we take that into account, then we would have a different scenario. So in looking at this differential analysis, there's a loss of $28 per unit from buying the instrument panels. So when we take that into account, that fixed overhead, the instrument panels should be manufactured in-house. Again, like they're saying, you got to look at the fact that if you do choose to make the panels, then there's nothing else available for any other types of production. Okay, what about keeping equipment or replacing equipment? Differential analysis can be used for decisions to replace fixed assets. The analysis focuses on the cost of continuing to use old equipment versus replacing new equipment. I know I'm kind of getting crazy here, but I think of this often when I see the cost of cars. Oh my gosh, guys, I've had so many clients this year purchasing new cars. And I mean, I have not seen a new car for probably under 50,000. And then these trucks, I mean, these clients are purchasing a truck for 90,000, a pickup truck. And so I know there's more appeal or different decisions people make to having a newer car, but I've got a 2018 Infiniti FX60, and I might have to spend a little bit of money in repairs because it's at 120,000 miles. But my cost of holding on to that car versus purchasing a new car is just because that's a car is a car to me, and I don't need to have a new car. But these guys, it's so expensive. Anyway, I'm going off track here a little, but in the same concept for businesses, do you keep an old piece of equipment that you know could break down or have more maintenance, or purchase new? So in this case, here's this old machine. It's already been depreciated, so our book value on it's sitting at 100,000. We've got some variable manufacturing costs we know we'll need. And then in 5 years, we could sell it for $25,000. Or do we purchase a new machine for 250,000 and we know we're going to have some variable costs of 150,000? But at the end, there's no residual value on that new machine. So again, we look at it. If we stay with our old machine, we've got our costs of 1,125,000 over 5 years. If we sell the old machine, get a new machine, we've got the cost of what we think we can sell it for. We have the cost of the new machine and the variable costs. And in this case, based on what we know, it looks as though the benefit would be to purchase that new machine. There's a 5-year differential effect on profit and income of 150,000 from replacing the machine. The decision based on that information should be to purchase the new machine and sell the old machine. Again, there are other factors that you need to look at. Like they're saying, the new machine could improve the overall quality of the product. or the remaining useful life of the old machine and the estimated life of the new machine need to be looked at. Another thing that we aren't looking at in these figures is the time value of money. So that is important because money has a cost. The revenue that is foregone from an alternative use of an asset, such as cash, is what we call an opportunity cost. I know you guys have talked about this in other business classes, but what is the opportunity cost of you choosing to go be here in class today versus what you could be doing? Then we have processing or selling. In manufacturing, products normally progress through various stages. In some situations, we could sell a product at a certain stage of production, or we can continue processing it further and sell it. But that processing further costs money. So we can use our differential analysis to decide, do we sell a product at a certain stage, or do we choose to process it further? Again, that differential analysis and then the cost associated from continuing the processing have to be looked at. The cost of producing the intermediate product isn't going to change because those costs are going to happen if we get it to a certain point or if we process further. We only look at the cost involved with the differences, the choices between A and B. So this kerosene is an intermediate product, but we could choose to process this kerosene further to make gas. So if we look at kerosene and we see 4,000 gallons and we look at the cost of just producing the kerosene, we see that that cost is at $2.50 a gallon. Now we have to then look at what is to move it to gasoline. And guys, I'm so ignorant with this process. So I'm not familiar with how all this plays out. But it looks as though that evaporation happens in the gasoline process at 20%. So then we only end up with 3,200 gallons of gasoline. But to produce that 3,200 gallons of gasoline is going to cost us $3.50. Excuse me. It's going to cost us $3,050 per batch. And we will then be able to sell it for $1 more per gallon. Hence, it's only 3,200 gallons versus 4,000 gallons. So if we look here, we see the kerosene. If we look at the profit per batch, it's 7,600. If we look at processing it into gasoline, our profit is $8,150, knowing that the revenues, it's $3.50 a gallon at 3,200 gallons. But it still shows we should process further and process it to gasoline. Other types of analysis involve maybe producing products and selling them at a lower than desired price just because we have that capacity to make the products. A company could be given the opportunity to sell its products at a lower price. Differential analysis would be used to decide, Should we accept that additional business? So here you see we normally produce 12,500, or the ability is to produce, we have the capacity, how about to produce 12,500 basketballs, but we currently do produce 10,000 basketballs. And we sell them for $30 a basketball. And we've got our variable costs and our fixed costs of $20 a basketball. But we're getting an offer to sell 5,000 basketballs at $18 each. Production has to be over 3 months, so normal operations aren't hindered. So what would we do in this case? So here, if we don't accept this extra 5,000 basketballs, there's no profit. But if we accept the order, we see we've got our revenues instead of at $20, they're at 18. And because the fixed cost would not be playing out in this special order, we would only have to look at our variable costs. And we'd see that overall the company would make an additional 27,500 in accepting this special order. So guys, what are costs that have been incurred in the past and can't be recouped? Sunk, right? Sunk costs. Stowe construction companies considering selling excess machinery with a book value of 25,000, and you see what we bought it for less our depreciation, for 35,000, less a 5% brokerage commission. Or we could lease the machinery for 48,000 for 4 years, and then it would have no residual value. But we would have costs to maintain the leased equipment of about $12,000. So we will prepare alternatives. Alternative 1 is to lease it, or alternative 2 would be to sell it. So you see, if we lease it, we'd get revenues of 48,000, but we'd have our cost of 12, and we'd have a profit here of 36,000. If we sell it, we'd make 35,000 and we'd have a commission. So ultimately, which one would we choose if it's just based on money? We would choose to lease the machinery. How's everyone doing? Is this making sense? I like this chapter because this is where the real meat and potatoes is in making decisions. So a condensed income statement by product line for Livonia Beverage indicates the following Vim Cola for the past year. It shows our sales, our cost of goods sold, our gross profit, our operating expenses, and our operating loss. It's estimated that 25% of the cost of goods sold represents fixed factory overhead cost, and that 10% of the operating expenses are fixed. Because Vim Cola is only one of the many products, the fixed costs will not be materially affected if the product is discontinued. What should we do here? Well, if we continue with it, we've got a loss of $1 million. But look what happens if we discontinue. Then we're going to have a loss of $2,850,000. So what should we do there? Continue it. Okay. So we can look at a service company. Charles Schwab is a brokerage firm, and they have investor services and advisory services. And you see the revenues for each segment. How does a brokerage company define what an investor service is versus what an advisor service is? Investors serve retail customers. Advisory services include the same services, but they're provided for banks, mutual fund managers, insurance companies, and pension plans. The variable cost would be commissions and fees for executing trades and advertising. The fixed cost would pretty much be that depreciation and those hard costs that aren't going to change: insurance, property taxes. So you see the operating income for each segment. If you look at the depreciation, you come up with then what the contribution margin is for each of these segments. If the fixed assets were sold for no gain or loss, then ultimately the operating income decline would keep growing and be significant. Okay, guys, let's look at this one. On the basis of this information, the general manager of Hawkeye Shoes decided to discontinue children's shoes because it reduced operating income by $30,000. What is the flaw in this decision if it is assumed fixed costs would not be materially affected by the discontinuance? Well, again, we know if we continue with the shoes or we discontinue, all of those fixed costs are going to continue. And then we don't have any revenues to offset those fixed costs. So that's really a key here that we continue to look at. Sure, the variable costs, but the fixed costs are there no matter what. Okay. You guys can go through these. I have a ton of these in here, and that will be helpful for you to look at. But I think you've got the gist of how this is utilized. And this will be helpful for you to look at these various problems. So, setting normal product selling prices. Normal selling price is the target selling price that we want to achieve. So we want to make money, we want to cover our costs, and this is where we aim to go. Managers can use one of two market methods to determine selling price: the demand-based method and the competition-based method. Demand method set according to the demand of the product, but the competition-based method sets the price according to the price offered by competitors. So managers can use one of three cost plus methods to be able to figure out how to sell the product. Do we do the product cost method? Do we do the total cost method or the variable cost method? So cost plus methods Determine the normal selling price by estimating a cost amount per unit and adding a markup. So we would figure out the cost amount plus our markup gives us our normal price. Management determines the markup based on the desired profit for the product, and it must be sufficient to earn the desired profit plus cover any costs and expenses that are not included in the cost amount. One second here, guys. Okay, so sorry about that. So basically, they figure out what do they want the profit to be, and it needs to cover all the costs. So under the product cost method, the cost of manufacturing the product, termed the product costs, are included in the cost amount per unit to which the markup is added. Estimated selling expenses, admin expenses, and desired profit all get included in the markup. Okay, so we've got our product cost method, which is the product cost and then the markup. So assuming that 100,000 calculators that Digital Solutions expects to produce and sell during the year, our costs are at 1.5 million, our selling expenses are at 170,000. We've got total cost of 1,670,000. And we want, with our assets, we want a 20% return. So if we look at that, we've got our costs of manufacturing of 1,500,000, our selling expenses of 170,000. So if we look at the cost minus or divided by our units, it's going to cost us about $15 a unit. If we want a rate of return of 20% on our assets, then we want 160,000 in profit. So we would take our costs plus our profit we want and divide that by our total manufacturing costs to come up with the markup of what we need to sell the products for. So if the markup is sitting here at 22% and our costs are at $15 a unit, then we know we need to sell the products for, sorry, I'm getting myself a little lost here. We know what we need to sell the products for based on what we need to mark it up for. So we need to mark it up $3.30 per unit. And if our costs are sitting at $15, then we need to sell it for $18.30. Target costing is a method of setting prices that combines market-based pricing with a cost reduction focus. Under target costing, a future selling price is guaranteed or is desired using the demand or competition-based methods. So we look at target costing by thinking of our expected selling price less our desired profit. This is normally less than the current cost, and managers have to find ways of reducing costs in order to do target costing. You use this when the market is competitive. So if our current market price is set, and we know what we want to make, but we know in the future the expected market price is going to go down. The only way this will work is if we cut our costs. The only way, cut the costs. So La Femme Accessories produces women's handbags. The cost of producing 800 handbags is as follows. We've got our direct materials, our labor, our manufacturing overhead. The selling and administrative expenses are $17,000. The management desires a profit equal to 22% of the assets that are $250,000. Determine the amount of desired profit from the production and sale of 800 handbags. Determine the product cost per unit for the production of those 800 handbags. Determine the product cost markup percentage for handbags. And then ultimately, we're going to come up with the selling price. So we want a profit of $55,000. So the cost is $40 per unit. So if we're selling 800 units and we want a profit of $55,000, we've got to take our $55,000 plus our selling and admin expenses of $17,000, divide that by our product costs, and our markup is 225%. So if it's costing us $40 per handbag, you have to multiply that by 225% to then know what we need to sell the product for. Okay? Smart Stream uses the product cost method of applying the cost plus approach to product pricing. The costs of producing and selling 10,000 cell phones are shown here. SmartStream desires a profit equal to a 30% return on invested assets of 1.2 million. Again, we're going to go through this whole process. So our profit is 360,000, the 30% of the 1.2 million. The costs are $250 per unit. So we have to figure out what we mark it up. We're going to take our profit plus our selling costs, divide that by our total manufacturing costs to come up with a 30% markup. So if each cost is $250 per phone, we have to mark it up 30%. We could then sell each one for $325. Toyota uses target costing. Assume that Toyota marketing personnel estimates that the competitive selling price for the Camry in the upcoming model year will need to be $27,000. Assume further that Camry's total unit cost for the upcoming model year is estimated to be 22,500, and that Toyota requires a 20% profit margin on its selling price, which is 25% markup. What price will Toyota establish for the Camry? Well, the price will be set at the estimated market price. That's going to make us stay competitive. Under the target cost concept, we don't dictate the price, the market's going to dictate the price. The required profit of 20% implies 21,600 target product cost. So, in other words, what we're doing is we know what the price has to be. We've got to reduce the cost. So we only can put in 21,600 in costs on each Camry. Because the estimated manufacturing cost of 22,500 exceeds the target cost of 21,600, Toyota must reduce $900 from its cost in order to maintain competitive pricing. So target costing is with a competitive market. Bottlenecks. Bottlenecks, constraints is a point in the manufacturing process where the demand for the company's product exceeds the ability to produce it. The theory of constraints is a manufacturing strategy that focuses on reducing the influence of bottlenecks on the production process. When a company has a production bottleneck, it should attempt to maximize its profits by using the unit contribution margin of each profit of each product per production bottleneck constraint. Pride Craft Tool Company makes 3 products, A, B, and C. And all 3 products are processed through heat treatment, which hardens the steel. The heat treatment process is operating at full capacity and is a production bottleneck. The product unit contribution margin and the number of hours of heat treatment used by each type of tool are shown. So with product A, we've got 1 hour of heat treatment. Product B has 4 hours and product C has 8 hours. Product C appears to be the most profitable product because its unit contribution margin of $128 is the greatest. However, the unit contribution margin can be misleading in a production bottleneck operation. The best measure of profitability in this bottleneck production is the unit contribution margin per bottleneck constraint. The bottleneck constraint is in the heat treatment process hours. So the unit contribution margin per bottleneck constraint is shown as the unit contribution margin divided by the heat treatment hours per unit. So with product A, we've got $90 per hour. With product B, we've got $25 per hour. And then our unit contribution margin for product C per bottleneck hour is at $15 per hour. Of course, product A is going to be the most profitable. Product A is the most profitable product per bottleneck hour. If one product's going to be produced, we should produce A. But if let's look at what B and C are up to. We might need to also produce B and C. Products B and C need to be priced to product A or find some way to look at the process so they don't have so much consumption in that bottleneck. So, what's the best measure of profitability in a production bottleneck operation? Unit contribution margin. So, talking about bottleneck operations, Mill Metals has 3 grades of metal product. Mills operations require all 3 grades to be melted in a furnace. The furnace runs 24 hours a day, 7 days a week, and is a production bottleneck. The furnace hours required per unit of each product are shown here. Types 5 and 10 have the same amount of hours. Type 20 has 12 hours. The marketing department's considering a new marketing and sales campaign. So, which needs to be emphasized in this sales campaign? So, we're going to look at the differences. When we look at type 5, we've got 30 cents per furnace hour. If we look at type 10, we're talking 70 cents per furnace hour. And then when we look at type 20, we're at 50 cents per furnace hour. So type 10 gives us the most unit contribution margin per hour of furnace resource and ultimately is going to be the most profitable. 20 has the largest profit, but if we're looking at it under these bottleneck constraints, we would not go with type 20. Objective 4, yield pricing in service businesses. So service businesses, unlike the manufacturing, can have larger fixed costs because they're needing property, plant, and equipment to deliver services. So oftentimes with service businesses, there's higher fixed costs, lower variable costs. It changes the the pricing. When the demand on fixed capacity is high, prices are higher. When the demand for fixed capacity is low, then the prices are lower. Yield pricing is accepting business at a special price. Alpine Airlines has fixed costs and variable costs per flight. The plane has a capacity of 200 seats, and 170 have already been sold at an average of $150 a ticket. The contribution margin per passenger is going to be the ticket price minus our variable cost, which is sitting at $115. And we know we come up with that contribution margin so we see how much is available to pay for our fixed costs. So we have a break even of 160 seats. We've sold 170. So we're already at the break even. So anything else is just going to be a bonus. Each flight's earning a profit since we've sold 10 seats more than the break even. So to attract customers to its unsold seats, Alpine's offering a 50% discounted ticket. If 10 passengers purchase that discounted ticket, Alpine's already going to have extra income because we've already hit our break even. We're already making money. And so that extra per ticket, even though it's discounted, is income for the company. So this appendix talks about setting normal price. Again, we know normal price is the cost amount plus our markup. The markup should be sufficient to earn a desired profit plus cover any cost and expenses that are not included in the cost amount. If we look at this total cost method, manufacturing costs plus the selling and admin expenses are included in the total cost per unit. Then the markup per unit is computed and added to the total cost per unit to determine our selling price. Okay, so we take our manufacturing costs, our admin, our selling expenses. We add that to the markup. The total cost method is figured out by taking our calculators, and we've got our manufacturing cost, our direct materials, our labor, our factory overhead broken by variable and fixed. We take our selling costs and we then come up with what we want a return on our assets to be. So based on this, if we take our total costs plus our manufacturing costs, our selling and ad, we take that 1,670,000 divided by how many we're producing. We come up with our cost of $16.70 per unit. We take our desired profit of 160,000 and we come up with a markup of 9.6% per unit. So if our cost is at $16.70, we'll add our markup at 9.6% to come up with a selling price of $18.30 per unit. The ability of selling $18.30, the selling price to generate the profit, is shown here. We show our sales minus our various costs, and that's what our income we want to have plays out. The variable cost method is we take just our variable costs, and then with our markup, we put in our fixed cost and our desired profit. So this only includes the variable cost in the cost amount. And then the fixed manufacturing costs and the fixed selling and admin and desired profit are added to the markup. So in this case, we've got the normal selling price of $18.30. We determine that by our variable costs. We come up with our variable product costs. And then we estimate our total variable selling and admin expenses. We have that at $150,000. So we've got our direct materials, our variable direct labor, and our variable factory overhead. And then from there, we come up with our variable cost of $16 a unit. And if we want to then show our markup, sorry, this is a mess here. We take our desired return times our total assets at 20%. We need to add our 160,000 to it. Let me just fix this. I can't see that very well. Sorry, guys. I apologize. That better? Okay. So we're going to take our desired profit plus our total fixed costs and expenses. So our markup plus our total fixed is sitting at the 230. Our variable costs are at 1,600,000. So we then are going to need to have the markup at 14.4%. The 14.4% times our variable cost per unit of $16 means we're going to need to mark it up 230 per unit. We're just having different formulas in order to set the selling price. Which cost method is often used by contractors that sell products to government agencies? It was back there and I didn't talk about that, but it is the total product cost, total cost method. SmartStream uses the product cost method of applying the cost plus approach to product pricing. The costs of producing and selling 10,000 cell phones are as follows. SmartStream desires a profit equal to a 30% return on invested assets of 1,200,000. Determine the amount of desired profit from the production and sale of 10,000 cell phones. So let's look here. If we've got our variable cost of 10,000 units, 2,400,000, we've got our fixed costs of 490,000. We've got 2,890,000 total costs. We divide that by our 10,000 units. It's $289 per unit. Then, if we know our profit is going to be based on assets of 1,200,000 in assets, and we want a 30% rate of return, then 360,000 needs to be our profit. We divide that by our total cost. That means we're going to have to mark up each cost 12.46%. So our selling price would be $325 per unit. Guys, any questions? How's everyone doing? Everyone doing okay?
Doing good.
Any questions before we sign off, guys? Well, you guys have a wonderful week. Guys, we're going to be in class next week, okay? I'll see you in class. Bye.
Excuse me.
Yes.
So I joined in about 15 minutes late. Is it possible I can still get attendance?
I'm sorry, John. I'm sorry. You can ask someone to get you the solutions, but no.
That's well, I'm fine with not having solutions. I'm talking about just the attendance, the points.
Um, you know what? I'm sorry. I took attendance around 10:05, okay?
All right. Thank you.
Bye-bye.